Hello and welcome. I'm Jonathan Beale, and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. With the unemployment rate falling to 4%, Chris Tennent-Brown is back to talk about whether he sees this rising again or is the worst behind us. We also chat about the impact of the latest Auckland lockdown and how low we could expect interest rates to go. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Hey, morning, Christopher. How are you? Good to talk to you again.
Oh, morning. Still stuck at home, but I must say I'm pretty excited about changes of alert levels these days. If it means that I get to get out and about, and I can't believe I'm saying it, but I can't wait to get back into the office for a bit of face-to-face contact with friends and colleagues.
I'm the same. I've not really enjoyed this level 3. I think I was all right last time. This one I found quite difficult, and so yeah, come next week when we can go to level 2 and do what we gets a little bit more normal, I think will certainly help the how I'm feeling and the sort of my mental well-being and also my liver's well-being as well, because that seems to be taking a bit of a hit at the moment.
Yeah, I must say I was a bit embarrassed putting the wheelie bin out this fortnight, and I definitely need to offset it with some exercise.
Yeah, I certainly when the machine comes along and picks up the wheelie bin and dumps it, there's lots of bottles and banging and glass being smashed, and probably more than normal. Hey, that's one of the. But we're helping keep the economy going for the alcohol economy going, which is probably a good thing. But
right.
We should probably talk a little. Yeah, exactly. So we're in level 3, and I suppose we saw certainly sort of the impact of. At level 4, level 3 last time, and then obviously level 2. But like, how is the sort of level 3 and in Auckland lockdown affected the wider economy, do you think?
Well, I think level 3 is an awful lot better than level 4 in terms of the ability to go out and do things. You know, things like builders can keep going and so forth, and more shops can stay open. But we still calculated that this was costing hundreds of millions per week for us to be locked down. But it's interesting because it's come at a time when a lot of the other things in terms of the economic recovery over the second quarter of the year were going better than we expected. So when we look at our year-end forecasts, they're not much different now compared to what we were thinking prior to this latest lockdown. So we were having some good things as well as this latest bad thing. So we still think we'll end up the year with the economy about 6% smaller, and the unemployment rate higher. But even on that front, we got quite a big surprise that the labour market data that came out over the last couple of weeks has actually been quite a bit better than we expected. So the answer is it is having a negative impact on the economy, but we're probably at a slightly better starting point when we went into this lockdown than what we were thinking would be.
And just out of interest, when you say sort of, we've worked out we're losing, hundreds of millions a day, like as an economist, how do you can you give some insight on how you actually do that? Like,
yeah,
what are you looking at?
With the economy, we get lots of granular data about activity, and we sort of build up economic activity by looking at all the various sectors, and we can look at things like our own credit card data to see what sort of a hit, say for example, the hospitality sector's taking, and we look at things like people movements using Google to think, okay, what's this doing for the for people's activity and for transport activity. So we use all sorts of bits and pieces to try and come up with these numbers. And I don't sort of die in a ditch whether the number's 300 million or 400 million. They're big numbers, and so it's trying to work out is this really significant over the long run? And can we afford to be doing subsidising the sort of loss of activity? But we do it by looking at all sorts of data, and then to being honest, taking as best and most informed guess as we can about what it all means. And so we don't always get it right. And for things like the labour market, we love when we get it wrong, and it's telling us that the economy was going better than we expected. So we often get surprised by the actual outcomes of data.
Exactly. And what were some of the reasons around the unemployment? What was better than, or particular industries that were better than than you thought?
Well, the main story in the unemployment rate, which is still sitting around 4%, it didn't bounce up to 6% like we thought it would, and this comes down to definitions a little bit. There's a lot of people that are still employed but on a subsidy, so they would think that they are actually unemployed, but they technically still are employed if their employer is paying them the wage subsidy, and so that feeds into it. But there's literally hundreds of thousands of people in that situation that aren't working, that are getting a subsidy, but within the labour market statistics they are counted as employed. Where you probably see the devastating impact of the lockdown is something like the hours worked figure, which actually does try and estimate how many hours are people working. And hours worked has fallen by about 10%, as some people literally can't work, and other people like you and I are still working, but just from home over the period of the lockdown. So there's a bit of measurement stuff going in there, but there's still some stats, and particularly that hours worked statistic, change of pay, which were pointing to the big downturn that we know we've had. But it was a better than expected starting point, and we still think the unemployment rate is heading north and heading up to 7% or so over the next couple of quarters, but we thought it would be. We thought it might be there or getting pretty close to there already. But these subsidies are keeping it down, and importantly, keeping money going into people's pockets.
Yeah, and I was trying to remember way back when I did economics at school and university, and just shows how long ago, because I can't really remember. But there is a particular level of unemployment that actually is a good level, isn't it? Am I right in saying that? Because we don't actually want zero unemployment from an economic point of view.
Well, I guess it depends on what you're talking about. There's kind of a natural rate of unemployment within an economy which you'd always accept as people move from one job to another. Yeah. And things like seasonal workers, for example, are always going to be unemployed at the end of the season, but hopefully not for too long while they get into another job. So there's a rate that you'd accept, and here would probably target something like a 4% unemployment rate. We'd start to think the labour market's actually getting pretty tight at that sort of level of unemployment. And so that's where we are right now. Whereas we'd think 7% is a lot of unemployment. Whereas in the past, those numbers have had much wider ranges. There's a period in New Zealand's time where no one was effectively counted as being unemployed. And the unemployment rate at bad periods was up 10%.
It's helpful because it gives a bit of context, really, I suppose, that if you say 4% is about, 3 or 4 is about right, you suddenly get up to 7 or 8, that's like double what you'd want and stuff. So you can see actually how that will have an impact on the economy here.
Absolutely, and so does the uncertainty of just not getting as much work as you want. So the underemployment rate or underutilization rate is an issue as well, and that's tracking higher at times like this. And I keep falling back to using my partner as an example, who is a flight attendant and now works in a rest home part time. So she's employed, but should be loving to do more work, and so she's in that underemployment sort of line of thinking where she'd like to do 40 hours a week, she's only doing 20 hours a week. And there's a lot of that going on in the labour market at the moment too. So there's all sorts of moving parts.
Yeah, because I'm seeing it in sort of the insurance side of the business as well, where, the reinsurance costs of getting redundancy cover have almost tripled over a short space of time. So we're seeing more claims, and then obviously the outlook for redundancies is much higher. So you're starting to see it in lots of different places where it may not have actually arrived here today, but it's certainly that can has maybe been kicked down the road a little bit, but certainly going to start playing out after we get out of level 3 back to 2. We start to see the wage subsidy finish and all that type of stuff. I think that's when the reality is really going to hit, isn't it?
Yeah, and there's still this big missing part of the economy, which is the international component, the tourists and the international students. And that will be the bit that keeps us at this 95% economy for quite a while. And I guess that's the disappointing thing over the last few months, is that that travel bubble just looks further away. So while we've had some things which have gone well, this latest outbreak and combined with the one in Australia is just showing how hard to get those travel bubbles are going to be.
Yeah, I'm glad you mentioned travel bubbles, because I suppose that I think we were planning, weren't we, to get our own little travel. We were going to fly from Auckland to Tauranga, and you were going to fly us, and level 3 then stopped it. So there was the end of our little travel bubble. But sort of wider travel bubbles to Australia or to the Pacific Islands, are these actually realistic idea now, or they just don't seem to? It just seems too hard, doesn't it?
I think I think with outbreaks like this, it just pushes it even further down the road. If both New Zealand and Australia are really trying to eliminate the virus, the border's clearly where it comes in, and we can see how quickly it spreads. I think even if there weren't restrictions right now, and thinking back to your insurance comment, I don't think anyone would, or many people would want to travel to places like the States right now, and I certainly think it'd be very difficult to get travel insurance to cover your healthcare if you were to go there. And so even if it wasn't for the rules, the disease itself, I think, is making travel look really restricted and unrealistic in a large commercial scale over the year ahead. So within our forecasts, one of the things that we have done is we've factored in some of these better things like the labour market, but also preparing for slower recovery and things like the travel sector. So that's pretty tough news until solutions are found for education. I know they're working hard on trying to solve that one with quarantines for students, and things like the Trans-Tasman bubble or Pacific Island bubble, I think, are really, really difficult right now. We've got cases still in the community.
And that's got to be more bad news for people like Air New Zealand and the airport, surely.
Exactly, and if we look at their share prices, both those companies have been strong performers over the years, but their share prices really show are a barometer of COVID-19. Air New Zealand $3 back in December, down to 80 cents in March at the worst of it. Then in June it was nearly at $2 when we thought a Trans-Tasman bubble looks likely, things are looking better. We were starting to travel a lot domestically. That was when we probably flew down to Wellington and did our Wellington function, and then it's back to $1.40 today with this latest setback. And if you look at Auckland Airport, same sort of pattern there. So those stocks have really showed the highs when things were going really well last year, and then the lows when we've been really worried about COVID-19. But hey, it's not all negative. If we look at the other end of the scale, Fisher and Paykel Healthcare, Gee, that stock was $15 a year or so ago, and it's just under $40 now. And it's gone from strength to strength because it's providing solutions, literally respirators and equipment to help with patients with COVID-19. But it's interesting looking at these stocks that are that really are a barometer of some of these themes, like solutions to the problem, or Trans-Tasman travel bubbles, that sort of thing. The share prices are conveying what's been going on, that's for sure.
You're right as well. There's sort of maybe a third category as well. It's sort of the stocks like you talk about. Fisher and Paykel have done so well, and maybe A2, and then sort of stocks like Air New Zealand and Auckland International Airport. But there's that sort of stuff in the middle around sort of companies that have historically paid good dividends. They've seen some of those companies sort of pause their dividends or reduce their dividends as they work their way through COVID. That's had an impact on their obviously their share price. Do you see the sort of those types of companies with historically good dividends still being able to do that in the future, or is this a bit of a change that we're seeing here?
I think companies that it's understandable that most companies are experiencing some fluctuations in their income streams at the moment, and that's impacting their ability to pay a dividend in the near term. But I think over the long term, companies that pay good dividends will be really well rewarded in this economy. Particularly if I think about what's happening with interest rates. Interest rates are getting so low, and people will want to look for an income stream. So companies that can pay a good dividend, and New Zealand's well known for that, I think will get rewarded in the future and well supported. So I don't think that's going to be a feature of the New Zealand share market that disappears anytime soon, although it's clearly under pressure at the moment because of the economic circumstances. So
yeah. That's a really good
hopefully
point.
they'll resume and continue in line with the recovering economy.
Well, we can't have New Zealand shares not paying good dividends, because then I won't be able to use my 3 reasons why I moved to New Zealand, which was the people, the beaches, and because the shares pay good dividends. If they don't pay good dividends, then I'm out. I'm down to 2. What am I going to do? I need a third reason.
Exactly. Those are good reasons to be here. So hopefully they'll continue to hold you here, JB.
Exactly. Now, I couldn't have a podcast and talk to Chris Tennent-Brown without talking about interest rates and the sort of the gorilla in the room around negative interest rates now. And so it seems that this is sort of not it might happen, is more like it's going to happen, but it's going to be about timing. Is that what you're saying now?
That's right. We really, as an economics team, changed our view in August, and this was really to do with the seriousness that the Reserve Bank's talking about a negative official cash rate. And so within their monetary policy statement and all of their communications with the banks, they've been really, really pushing hard to make sure all the banks are ready for a negative official cash rate. They're not saying we're going to do it. They just want us to be prepared for that possibility. But we now think that that's extremely likely, and that in early next year they'll cut the official cash rate into negative territory. And we also think that, based on what they're talking about, is that this will go hand in hand with more funding facilities for banks. So the official cash rate's just an overnight interest rate, but if we look across in Australia, banks can actually fund at the official cash rate for much longer terms, for 3 years. We can get business loans through a lending facility from the Reserve Bank, but we think they'll broaden that up, and that will flow directly into effectively the bank's borrowing costs and lower them considerably, in particular if there's a negative official cash rate. So we think all of that stuff is going to come out next year. What clients want to know is, what does that mean for interest rates for them? And we're not expecting clients to have to pay to have a term deposit with us, but those term deposit rates will get lower under this scenario. I'm picking they'll fall well under 1% for most terms. They're not far off that now. And I think mortgages can get lower too. Maybe we'll see a mortgage under 2% in New Zealand over the next 12 months. Like you said, the timing's difficult, but we think that's coming. And I'm actually we've got a report up on our website about this if clients are interested in reading about it, about the negative OCR.
And then, because I saw an interview with Stevie J from Kiwi Bank, and he was sort of similar thing about probably seeing mortgages with a one at the front, and you'd have a similar view.
Yep, that's what we're thinking. It's a big call, and people want to know an exact sort of number. So I'm picking that we will see a mortgage with a one at the front of it. I think it'll probably be a fairly high one, but they've got a little bit to fall in this environment. But there's more moving parts than usual to our mortgage rate forecast this time, and so picking the exact timing of it is tricky. And for people that are interested in that, just keep an eye on our regular reports that we put out, and we'll be talking about it. It is constantly changing, and this is a pretty new thing for us to go to actually forecast a negative official cash rate. So one of the things I've been doing during this lockdown is making a gigantic spreadsheet to try and work out how a negative official cash rate actually flows through and impacts all of our products, including some of the including investment portfolios, obviously, because most investment portfolios will have some cash in them.
And how have you come to a conclusion on how you actually think negative interest rates will affect sort of diversified portfolios going forward?
Yeah, the thing that we're seeing right now is, the Reserve Bank's essentially running a suite of things at the moment. They're talking about these negative official cash rates. They're buying government bonds. They've got a record low official cash rate setting. And so some of the stuff's impacting portfolios now. Over the long run, what it's going to mean for portfolios is that we're going to have a few years where any cash in a portfolio is going to be very unrewarding. The return on that 10 years ago used to be a pretty positive contribution to a portfolio. Now it's going to be next to no contribution. So that'll impact the amount of cash that people want to have in their overall investments. Things like bonds, the capital value of bonds are really getting driven higher by the Reserve Bank's bond purchases. So that's good news for existing investors. But in the long run, it's going to mean that we'd expect pretty low returns from the bonds held within portfolios. And this is the weird thing for investors through all this strange news and turbulent times. Well, the shares have actually been going really well within portfolios, and the New Zealand share markets has pretty much recovered from the March dip. The US share market's trading at an all-time high now. So these things that our Reserve Bank are doing, in combination with the central banks in other parts of the world, are actually really been pretty positive influence on portfolios if we look at them where they're standing today. So it's certainly not all negative for investors at the moment.
It's really interesting. In the last 24 hours, I've had two sort of instances where actually the low interest rate environment, how things have changed and people's behaviour. So because things were very different when interest rates were higher. And if the two instances was there was a piece on the news about share clubs and young people getting together to talk about the share market and how you invest and what type of stocks to pick and why. And it was just fascinating. And then yesterday morning I was buying a coffee down in Devonport, and there was lovely two ladies down there who were getting a coffee, and one of them had a yellow umbrella, and I said, "Oh, is that an ASB umbrella?" And she sort of said no, because she goes, "It's a quality one," which I didn't know what that meant. But she said that we just started chatting, and she goes, "Oh, do you work for ASB?" And I said, "I do, actually." And she goes, "Oh, I've got my KiwiSaver with ASB." I said, "Oh, that's awesome. That's great." She goes, "Oh," I go, "Why did you do that?" And she goes, "Well, I'm over 65. I didn't realise I could join, and then I found out I could join, and I had some money in the term deposit, and it wasn't doing anything, and I put it into KiwiSaver, and it's been doing great, and I'm it's chugging along, and I'm really happy with it. And the lady next to her said, oh, I did exactly the same thing. And you're like going, that wouldn't happen a few years ago, would it? Like people going, I'm actually going to move, I'm 65, I'm going to move out of term deposit and put something in the KiwiSaver, and feel very comfortable and confident about it and pleased with their decision. I think that there's some very different behaviours going on with interest rates being so low, isn't it? Fascinating.
Oh, yes, absolutely. And it's really pleasing to hear people making decisions to do something longer term with their money to generate a return. And we just simply didn't have to do that a few years ago when term deposit rates were so much higher. I mean, even 5 years ago, people would think, hey, if I can get 5%, that's all right. And their conversation would be about what term to take to get the best rate. Now, when you're talking about no rates being higher than 1.5%, if people are taking a longer term approach and looking at different products, including KiwiSaver, it's really encouraging. And back to your question about dividends, I know our colleagues that sit, when we're not working at home, on the same floor of us in ASB Securities have been absolutely flat out with people talking about investing in shares to generate a decent dividend yield. So these low interest rates definitely are making people think more about investing, and that's a really encouraging sign, as long as they're making well thought out sort of long-term decisions, because most of these products are pretty long-term rather than short-term, like a lot of people's term deposits were focused.
Exactly, and get some advice and get some guidance and read up and read a lot of stuff that you put out and the blogs and stuff, and then make the right decisions. But it's great to see people actually really thinking about it. Okay, I might call it a halt there. I just wanted to pick you up on one thing you did say, Chris, that when we were talking about mortgage rates, you said it'll be one, but a high one, as though a mortgage rate that's 1.9 is still a high rate. I'm not quite sure that's what you meant, but if my mortgage rate was 1.9, I'd have a big smile on my I'd certainly have a big smile on my face. I'm sure a lot of people would, but
isn't it funny that as mortgage rates fall, we say, well, we've got a record low mortgage rate now, and instead of going, great, yippee, I'll get into that, the question is, well, how much lower are they going to get? We always want to see if we can fix at the bottom. But I think the key is over the next year or so we'll see some very low rates, and so for people that are in that market, it's going to be quite a booster.
Fantastic. All right, lovely as always talking to you, Chris, and really looking forward to catching up with you in level 2 and shake hands, have a beer, and go back into the office. So looking forward to it. Thanks again, and I'll see you shortly.
Okay, bye-bye.
Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.